One-year returns through Q3 2024 were up across all the strategies we track, the first time that's happened since Q4 2021. But at this point, that's pretty old news given how much has happened since. History tells us that it could be several quarters before we clearly see how private market valuations will react to the recent public market volatility. We went into 2025 with the general sense that the new U.S. administration would ease regulatory burdens and adopt a more lenient attitude toward M&A from an antitrust perspective. Add to this a continued drop in interest rates, and the outlook for deals seemed excellent. The hope was that a robust deal-making environment would help clear out the aging inventory of portfolio companies held by PE and VC funds. So far, Q1 has seen a deregulation trend in the U.S., but also heightened uncertainty around tariffs. The lack of clarity has made it difficult for companies and investors to make long-term decisions. I see three likely implications for private market investors. First, the denominator effect may return. LPs who had hoped to crystallize returns and reduce their private market exposure through distributions will have to hold on longer or start getting more serious about secondary sales. Second, I expect GPs will be availing themselves of NAV loans and continuation vehicles to support aging portfolio companies. And third, the ultimate returns on vintages invested prior to 2020 may be below historical averages, dragged down by both the pandemic and erratic 2025 U.S. trade policies. Longer hold times are not a friend to fund returns.